As of today, our go-to-market has been very much an affinity to the crypto space. I mean, it's where we cut our teeth. It's our deep insights and appreciation. Not exclusively, however. So we do have clients that are just bread and butter SMEs that are looking for personal service, or they're looking for something which is capable of understanding their business. And when I say understanding their business, a lot of our clients might have some feature to their business which isn't tick box. And we see that as an increasing trend. The debanking piece, for example, 140,000 UK SMEs were debanked last year alone. And that's 140,000 is not like it's not an immaterial figure. This is a very material figure. And that's just the UK. And the reason this is happening often is we've become very much a tick box approach to KYC AML. And there's nothing wrong with doing that as an individual actor, to be just by the book, saying here are the metrics, input, output.
Hello, everybody. Greetings. I'm in Singapore today, and today I'm speaking with Kiernan, who I've met in London, and I'm very excited because Sean represents a real-life application of DeFi principles back into traditional banking or traditional lending, at least. Okay, so let's get right into the conversation, and and I'm going to ask Sean to describe his business, and then I'm going to test a few ideas with him.
Perfect. And thanks again. Looking forward to the questions. We're a scale-up in that we're a Web3 fintech that is live. We offer accounts and lending through partners, in the sense that we're agnostic from traditional or digital, as long as our clients get access to the things that they need. Those two verticals being accounts for payments and cards, and then lending is loans in a classical sense or a digital sense. And I can explain what that means, but we've opened over 70 accounts as of today, and we've done over 100 million of lending.
So you have opened 78 corporate accounts.
Yeah, so our clients are SMEs and family offices, and we're filling in, I mean, the broad spectrum of what we see as debanking. So it's harder to get an account today for most businesses, particularly if you're in the crypto space. It's a struggle sometimes to get a traditional bank account. But we see an issue also with de-lending for our clients, where they're maybe not getting a loan from the traditional banks. It might be expensive for them to get a loan from a credit fund, and we're finding then novel ways for them to get access to money through partners like family.
So you have a balance sheet of your own where you do some.
So the beauty of our model is it's purely a platform. So we're a tech house when I say a fintech. So we work with partners. We're not regulated ourselves, but our partners are if needed. And we surface that product for our clients through our platform.
So how far are you from what the P2P model used to be?
Yeah, so P2P is still very much here. And that is fantastic, I think, for a smaller ticket. So if you're trying to transfer, maybe say take lending, crowdfunding, a couple 100,000 really works in that sweet spot. When I say the SME, we're more the M. So it's a bit bigger, minimum, say 1 million of lending up to 25. I think that's the clear gap in the market as the de-lending is taking place. The big banks do the big loans. They still do the small loans, but crowdfunding fintech has started to plug that a bit. We're in the middle.
Okay, and do you who holds the balance sheet? Like, is that directly to your customer clients, or do you work through a financial institution?
So it depends, and we're again agnostic. So if we're looking to facilitate a loan, we have what I call a credit library of partners. And in a sense, this is kind of classic. We make an introduction to somebody that we think is suitable, but the genius is in how we've done that. Because we have the accounts, we have the relationships, the KYC, the transactional data. We really know those clients, and we're able to matchmake with the credit library where suitable. So it might be another family office. It could be a credit fund. The really interesting piece is when I say digital, there are particular products we can facilitate which are something that the traditional world wouldn't necessarily think of. One being, for example, lending against crypto into fiat, which is something that if you have that kind of collateral, you're not always going to get a bank to consider it, or you'd rarely get a bank at all. And we can also look at something which is really innovative, which is tokenized private credit, which is wrapping, say, commercial paper digitally to get our clients access to money. And this is a nascent market, but we're looking at doing some interesting things there.
Oh, that alone is already a loaded description of your business, because there's several things in there, right? How far away are you from peer-to-peer lending, and why would you not see this as a evolution of peer-to-peer lending in what used to be? Is it because you've empowered the engine, your credit library, with a lot more insights into both the borrower and the lender? And then when you start talking about tokenized private credit, that sounds really exciting. Tell us a little bit more about how you go about tokenizing and what happens when you've tokenized it.
So I agree with you. I think peer-to-peer is a proxy, but I would say it's at the early stage, and as you say, perhaps what we're doing is an evolution, or maybe just a different take. As mentioned, I think the peer-to-peer space is great for the smaller tickets, and it's not necessarily too small. I mean, a couple $100K is still big enough for most people, but what you can do with the smaller sizes is use almost a completely algorithmic solution for underwriting. So you can use fully data-based analysis, package it up, and because of the beauty of the crowd, there's often more options, and so you can get an average approach, and then you don't need to have that heavy underwriting that you would for a bigger ticket. It's the reason that de-banking or de-lending is actually happening, because for something that's just that slightly more complex, and when I say 1 million to 25, there's usually a feature to that you might need somebody with some experience to kick the tires. And you can't just do that on an automated approach. It needs something that we call the Iron Man or the Iron Woman, where you can use the tech, but you need somebody with a bit of nous to dig in. For the banks, it's almost as expensive to do that underwriting for a small loan as it is for a big loan. And so for them, the margins aren't very attractive necessarily. And that's why there's been that sucking sound away from SME lending. In the UK alone, it's a £22 billion gap, according to the Bank of England. And that's something across the West, and I think across the East. What we've seen is that these new solutions, and when I say credit funds, I mean this really broad world of private credit. There is definitely an underwriting engine, but it's something that is using technology normally to manage that. And so that's not exactly crowd-based, but it's approximating. But it's a higher cost of capital because credit funds are not using deep deposit base.
Therefore, it's a value add that you provide to your lenders, in that you do the pre-qualification, you do the management, you do the origination in its totality, and there's a value add to your origination. It's not just originating to hive off. Is there a duty of care involved in that? I mean, like, does that expose your business to some form of obligation to your lenders?
Yeah, I mean, it's the nub of the question, actually, because we're not taking a credit risk yet. I think we will at some stage, if not the full thing. We'll maybe take a piece of it to gain trust. But there's definitely a reputational risk and a counterparty risk, because we're making an introduction. We're not giving advice. That's the one thing I've kind of made very clear. So we try to give options to our clients, who are typically borrowers. So here's a solution A, B, C, and then they can choose based on the parameters what's best for them. And this is a very different approach to when you go to a traditional bank for a loan, in that is a tied agent model, where the bank is really only going to sell you its own lending products or services. And what we're trying to do is be more what I call open finance. And I think Web3 and open finance are essentially sisters. There's a lot of commonality in the approach, and I like it because you're sitting on the same side of the table as a client. You're trying to help them find solutions that fit them. But the lenders are also then our partners, because if we bring them say, borrowers that end up not being a good fit, we will lose that relationship. And these things change all the time. And when I say credit library, it needs to be actively maintained, because sometimes a borrower will have appetite, other times a borrower will have different criteria, and it changes. That's kind of almost classic merchant banking style business. The bit that is, I think, very innovative is tokenized private credit. Everybody's talking about tokenization of real world assets. This is kind of the theme, other than meme coins, but we'll park that. The bit that I see as the real gap in the market is credit. And it's because of that mix that I've explained that the banks aren't doing it very much as much as they used to. And the credit funds are expensive. And the credit funds themselves didn't even exist at scale like a couple decades ago. They've emerged because of the gap in the banking market. But because of their expense, and because the SMEs are so struggling for debt, if you can get solutions in play that maybe are a couple percentage points cheaper, because you can cut out some of the structuring costs, you can maybe get access to a wider pool of capital that can compete with, say, a sole underwriter to facilitate a loan. We think there's a lot of legs in growing out that market, which is today, it's not too small. It's a 600 million plus minus market of real world assets that are posting debt on a blockchain via smart contracts. And they're using platforms like Maple or Centrifuge. We are seeing some interesting new entrants though in this market, the likes of Coinbase with their Diamond protocol is one that we're going to be looking at very closely, maybe to do a pilot of traditional SME debt. And when I say commercial paper, I mean it's not a loan in the sense of a fixed income regulated product. It's a different kind of product which is primarily B2B focused, and it's not as onerous to get into the market because of that lower regulatory burden.
What was happening on the crypto lending business, within the crypto universe itself? Are there best practices that you have taken out from it to build your business? Especially during COVID, like crypto lending was such a big thing, and now it's sort of just disappeared or just evaporated somewhat. Is there parallels between what you're doing and what was happening in the crypto lending space? And then you are starting to make me feel excited about the capital market aspect, which is, once you tokenize it, you can do anything with it. You can put it out there and trade it and stuff like that.
The crypto lending market itself has been fascinating. I mean, it's been in almost that past 5 years, we've seen booms, busts, bankruptcies, lawsuits, and some really interesting businesses that have survived. And I think there's probably 3 buckets of types of lenders. The traditional lenders, and these are banks, and there are some, the Swiss banks particularly, are lending against crypto. They're doing it in an interesting way, but it's kind of classic Lombard lending, if you will, or securities lending and borrowing. And there's a few family offices that are doing it in that sense as well. There were then the CeFi lenders, the centralized finance lenders, the likes of Celsius, BlockFi, Genesis. They've really had some interesting times in the market, and not many of them are still around.
Yeah.
And the third is the DeFi, the kind of native, smart contract-based, digitally native markets. Of the latter two, the DeFi markets have held up relatively. I mean, these are algorithmic solutions, but there are some upsides and downsides to all 3 of these. But the middle one really got hit, the CeFi, and I think we know why. Generally, some of these actors were behaving like banks, but without the appropriate controls or tier 1 equity in place to manage downside risk. And when the market moved against a few of these players, and maybe they were playing long duration balance sheet activities against short duration client activities, it didn't last. So from our learnings, we had to make sure that we had the appropriate counterparties for our clients. Again, back to reputational risk and issues of counterparty risk. And thankfully, we saw that we weren't going to introduce clients to a few of the CeFi lenders because of the inherent risks in their business models. We've steered more towards the traditional lenders because we feel comfort in our clients knowing that they're dealing with regulated counterparties. But my underlying interest very much is strongly in the DeFi side, and I think to your point, I'm sure you're going to take me, is the capital markets activities around tokenized private credit.
Once you tokenize an asset, you know there's so much that you can do. It's almost like end to end. It's from origination to to making it a tradable asset. How far down the road are you there on the other side of the equation?
Yeah, so I think we might be even a few months away from doing the first one. When I say origination, we're taking one of our clients that wants to borrow traditional SME debt, and we think we can get them a better rate by structuring it digitally. And we'll be doing that. It's not finalized, but with, I think, Coinbase, which would be fantastic. The idea of this whole value chain is that we have I think the need for multiple actors, and here I have some confidence in our proposition as well in that landscape. But it's very difficult to just build a platform and have people come. As you know from platform businesses, you need supply, you need demand, you need activity, excitement, you need that kind of center of gravity. And at these early stages, 600 million plus minus of that global tokenized private credit market is split across multiple protocols and platforms, and it's not yet reached critical mass. So if you build a new exchange, essentially, you need people to originate, you need market makers, you need that kind of robust ecosystem around it for it to come to life. And I think we can be one of those key components in being a funnel for our clients that are the SMEs or even family offices that want to borrow, to bring some of those every year to these protocols and say, here again are your options, our clients. You can consider the traditional debt, and here are your options. And we're trying to systematize the noise for them in that, because there is a lot of noise, even in the fintech world, for different types of lending. But in addition to that, you also have these digital options, of which tokenized private credit could be one. And we give the options to the client and they decide. And for our activities and helping them to source money, we take a fee, which is typically a success fee. But we're again sitting at the same side of the table of our clients, so we don't have an interest to missell because we're not selling our own product.
If I were to look at your, at your rates, for example, how much of your business today is really boils down to? I mean, you need to be truthful about this, if that's the case, which is it still boils down to rates. As opposed to technology or the friction of onboarding and stuff like that. Like it's still a price game.
And it should be. I mean, it's not just price driven, thankfully, because there are different features like duration or LTV or the source of collateral. I mean, these are more qualitative considerations, but are very important. Our business, and this is more from a Greengage perspective, is driven by those two verticals we offer, the accounts and the lending. So with the accounts, our standard fee is 5,000 per annum for a client. So it's a relationship-based service. We have to have and KYC, so that's an annuity income, if you will, but it gets us onto a personal relationship with the client, which is that old school, but very important, I think, in a Web3 context. Relationships and data, for me, are the only two sustainable things for a business like us. But because we have that annuity income, the lending, then we don't need to load all of our fees on, because we're not just a one-trick pony. We then facilitate, and our fees are typically, say, 0.5% to 1%. So they're not onerous. But if we're ending up saving our clients, say, 2%, or we're getting the money that they wouldn't get elsewhere, they're very happy to pay those kind of fees.
As you were speaking, I was thinking about someone similar to what you're doing in Hong Kong, where the lending is against cash flow of a business, right? And there, the technology allows the lender to be able to receive the cash flow on a daily basis, and they pick off the repayment from the daily cash flow. I mean, that's how technology-driven this business model can go. But yours is still a credit business, so you're agnostic to what the client actually uses the funds for at the end of the day. But you've also got a payment component to it. So just add that bit and give me an idea of how the supply chain actually works.
Perfect. So say we have a client that is let's say a crypto mining business. They have an account with us that we charge £5,000 for. They're using us for day-to-day payments. We have the KYC, the relationship. We know that they want to grow their business, but they have good cash flow. Maybe it's Bitcoin-based cash or the inbound, but obviously that's still something that they can work with. They have collateral in the sense that they have the machines, they have energy contracts, they have a whole host of things we could look at. In the case of your Hong Kong example, that could be one of the options in our credit library in the vertical for cash flow financing. There's also asset-backed financing. There's, a whole suite of different verticals in what I say is the credit library. And our job isn't to be that product or service yet. It's to be a warehouse. So we need to have, on an ongoing basis, relationships with the different verticals of the balance sheets that respectively provide the underlying product. And maybe as we scale, and this is kind of the vision versus the reality, because we're still, when I say scale up, we're building relationships as we speak. And the number of clients, when I say we're kind of approaching 80 accounts, we don't have the critical mass to justify hundreds of relationships for lenders. We've got a set of good relationships for lending, but we're looking to build as we grow. And again, because we're a tech-first platform, it's fairly easy for us if we find, say, a local banking as a service or payments as a service partner, maybe even in Hong Kong. We could sit on top of their platform, open up accounts on their platform with us providing relationship management, KYC, etc. But then we can then have entrance into a local market where maybe there's growth. I was recently in Dubai to try to kind of do a recce to see if there was an option for us to partner with the bank or payment service provider there, as an example.
And what's exciting is the capital market side as well. I've also had the opportunity to observe quite closely the attempts to create markets. Out of all kinds of different assets. In Singapore, there are several attempts at building commodity markets, digital platforms, and then also tokenizing them. And that's hard work because, firstly, you need to create the comfort level. Secondly, you need to create the liquidity in the marketplace and the desire to be transparent, about the asset. And so on, and then then it takes a while before a market actually comes to life. So are you putting the pieces together? What do you think will be the critical success factor of the other side of the equation?
I think you're spot on, and you're right to lay down the gauntlet. I don't want to knock the traditional markets. I mean, they work, and they work really well, and we see trillions of flow. I mean, this is not something to sniff at. There are pockets in the traditional markets, though, that don't work really well, and I think they're going to be the punch-through points for us to digitize first. We've seen some of the markets that are digitally native be the first movers, and that's almost by natural evolution. The NFT markets, the likes of OpenSea, you don't have a real world equivalent in the TradFi space to approximate that. I mean, maybe eBay, you could say, is kind of the closest, but this is a bespoke product. It's something that's come to market as a new thing. You can digitize that really quickly and have an efficient marketplace. Commodities, there are some gaps in the market, but there are metal exchanges. There's a whole ecosystem that's already in the traditional world. And to move that flow into a digital space, there's an uphill battle. It's not that you build it and they will come. As you say, you need to fight. You need to work really hard. And there has to be typically some push or pull. Maybe it's regulation, maybe it's market actors that agree standards and they want to save fees or they think there's some gain. I think the reason that SME debt is so interesting is because it's one of those, what I see as a punch-through point. It's a market that is not well served by the traditional players. It's materially impacting the growth of most economies because SMEs are the engine room of growth, and if they're not getting the money that they need, we actually limit the GDP and the potential for improved prosperity and productivity for economies. And so, and if we can create the demand side, the supply side is going to be your challenge to me. How do we get people interested to lend that are not yet there?
What technology do you use for your tokenization? Are you using a specific platform, or you're agnostic in a way? Are there certain platforms or certain cryptos that lend themselves well to being able to tokenize the assets that you have?
So we're agnostic as a house. As long as it's safe and it's scalable, we'll work with partners. Again, we're small, so right now our best bet is to work with big partners that have big balance sheets and have tried and tested protocols. Again, why Coinbase is so attractive is these products can still get hacked. I mean, this is early days in smart contracts. If something goes sour, Greengage doesn't have a huge balance sheet, so we need to go where we can with providers that are big. That doesn't mean they're the fastest moving though. It means that if things go wrong, I have access to money, or potentially even lawsuits if need be, but that's not necessarily my piece of the spectrum. I want to make sure our clients have come back, so to speak. We're not building the protocols. It's not my end of the market. What we do.
No temptation to build your own.
No, I think we're very happy to work with partners. I think for me, Web3 Open Finance is a partner-led approach. People will specialize in what they do best. And what we see as our specialization is accounts and lending. That's kind of what we do. And if we can get the right sources of tokenization for our clients, we can open up a whole suite of partnerships. We're not going to be exclusive necessarily. It's just where is then the piece that is going to be the real question? Where is the supply of balance sheet? Where is going to be the easiest hurdle for us to climb for our borrowers or maybe even our lenders to find each other? And I think that building of the marketplace is not going to be easy here either. I don't want to pretend otherwise.
Yeah.
But I think if we put really high quality product and we originate that on a tokenized platform, and if it's potentially with collateral that's also listed on the blockchain, so it can be interrogated publicly and it can be validated by a wide stream of actors. There are sources of capital that I don't think are being efficiently allocated today in the credit fund or banking side to access this SME debt. And I think those pools of capital could also be digitally native. I mean, we've got trillions now in the valuations of the crypto markets. There are people with long positions that might want to see those work. And if you tokenize, for example, on Cardano, and there's somebody with a long position of Cardano, that could be a way to bring some of that money into the system to deploy for a yield in favor of an SME getting some debt. And that kind of thing. As long as we can find a solution, we're happy to work where we need to make it to make a trade.
It sounds like that would be the viable future that will make crypto a living, breathing. Because right now, a lot of the features of crypto, are theoretical and they exist in silos, each one of them, and it doesn't release the value of the crypto into traditional finance, brings it back into what banks already do. That's one thing. The other thing that I want to explore with you is all these banks that are saying that they want to go into digital token. Would your business be the attractive asset class as a whole? I mean, your business as a whole, be the kind of digital assets business that they should be getting into, because that's where the real money is. That's the money that they understand in the first place.
I mean, it's for me fascinating to see this evolve, and I've been banging on about this for years. I mean, I've been talking about SME debt and digitization of debt for as long as I've set up Greengage, which is nearly 6 years now. And the markets haven't been ready yet. I mean, this is and why I'm so excited now. We're just starting to see the green shoots as the tech is developed, as the market acceptance has matured. I think the one difficulty for the existing banks to get into this market is it's completely different. It's a flip of their business model. So when I say a bank is a tied agent, it's got its own balance sheet from the deposit base, and it does fractional reserve lending to facilitate the net interest margin to release monies for lending. And if you think of tokenized private credit, this is the world as a balance sheet, and perhaps the bank could deploy some of that, but there's no benefit for them to just structure this again as a tied agent. This is maybe they could do that first step, maybe they could structure it and post it, but the challenge will be for them that they're effectively competing with themselves or giving up some of their margin if they're just doing it exclusively. That's why firms like us have an opportunity to work with the banks, because I think they will want in on the action, and we can sit with them or next to them to partner. But for now, I think it makes sense for them to continue with their traditional business models. And maybe as we scale in a few years, firms like us will become attractive targets, or will become something that the banks will look at as maybe a commercial collaboration, if that makes sense.
I've seen papers by the Bank for International Settlements encouraging banks to tokenize their deposit business. And so then that creates the links.
When I was saying the new pools of capital, obviously I think crypto could be, and you're right, I think this is one way to get the crypto world to bridge into the real hungry real world that needs capital. But I think banks and tokenization of deposits is going to be a whole game changer. Because again, we have, if we're tokenizing the debt side and sourcing that on an open platform, tokenizing deposits implicitly involves yield. We're not talking about just stable coins here. We're talking about some yield bearing aspect of a token that is on the asset side. And if there's a yield, there has to be some activity to generate the yield. And classically, that would be debt or some kind of balance sheet activity, which could
very
create
nice.
yield.
Yes.
Yeah. And then when those pools of capital start to open up, and perhaps, and this is the Web3 dream, we break the tied agent model and let the consumer, the one who's placing their funds for a yield, have a little bit more choice. I think there'll be more efficient allocation of capital. But this is kind of subject to regulation, subject to a lot of steps. But it's part of the dream, I think, that the too big to fail banks, as we call them, will always have a place in the market. But maybe they are too big to fail, and maybe they shouldn't necessarily be the only pools of sizable money. And we can then use technology and the consumer and the choice of consumer to start getting a more fair allocation of capital, and perhaps better yields or better rates for borrowers.
What kind of lenders and borrowers have been attracted to your model? What's the composition of your customer base on both sides?
As of today, our go-to-market has been very much an affinity to the crypto space. I mean, it's where we've cut our teeth. It's our deep insights and appreciation. Not exclusively, however. So we do have clients that are just bread and butter SMEs that are looking for personal service, or they're looking for something which is capable of understanding their business. And when I say understanding their business, a lot of our clients might have some feature to their business which isn't tick box. And we see that as increasing a trend. The debanking piece, for example, 140,000 UK SMEs were debanked last year alone. And that's 140,000 is not like it's not an immaterial figure. This is a very material figure. And that's just the UK. And the reason this is happening often is we've become very much a tick box approach to KYC AML. And there's nothing wrong with doing that as an individual actor, to be just by the book saying, here are the metrics, input, output. But as a collective whole, we lose the wood from the tree, so to speak. So we have a client, for example, that is an SME with a Swiss resident director and a UK resident director. So two nationalities on the board of directors. That isn't something that raises for me an AML risk, but it's not tick box. And if you go to a challenger bank, they just have an algorithm that will onboard based on metrics. And if you're one step outside of the metrics, and I call this one step outside of the train tracks, if you will, you fall outside of the scope and you're not going to get an account. And that's where we see a much bigger pool of clients than just the digital native clients that we have today, and more those that have any kind of trust structure, foundation, or they might have an international component to their business. That's kind of a huge pool of clients, and I think those clients would be great borrowers because they're often the ones that are doing stuff. If they have the complexity, that means that their business models almost geared towards growth or innovation because of the way they're set it up, or there's something a little bit different to them. I actually like difference, and I think we share that.
Yes.
And those are the kind of clients that we see are not being well served by the traditional market.
Right. Is there a fear in the traditional market that something like Signature Bank or what happened to the American banks might happen to them? So
Yes.
it's an area that they don't want to get into, or are they now treading with trepidation?
I would understand that as a driver if it's the sole deposit base or the sole client base. If you focus purely on crypto companies as a fully fledged bank, we've seen time and again that there's a flight risk of deposits because these are very digitally native, sophisticated clients, and they can, with the press of a button, you can't build a lending book on that. So I think that business model is very difficult to achieve, if at all. The traditional big banks, though, when I say the too big to fail banks, the globally systemic banks, adding a few crypto companies would be a rounding error to them. So I think that isn't going to be a reason that they don't get in this game. I think the reason for them not to do it is because it is too small. So it's not worth them investing in the KYC, AML systems of the unique compliance risk. It's a little bit too much of a headache. And I also think there's an aspect, and this is a bit unfortunate, but particularly the on and off ramping for retail, it's not necessarily AML risks that are at the fore. It's more that if there is a scam or a fraud, and the bank is seen to facilitate a payment to a scam or fraud, they could be held liable for said scam or fraud on behalf of the client. And so they'd rather just not touch it de facto. They limit the amount of inflows and outflows. And it's why our business model, again, kind of fills that to a certain extent, because we don't take that risk. It's very clear that our clients are adults and they can do what they wish, and we still have to follow all the AML rules by all means. But our clients are in the driver's seat, so it's again a slightly nuanced change to the relationship we have with our clients.
Right. So so everything. Okay, tell me now your sense of where do you think digital assets as an industry is going, and what's your course of direction like? You've already talked about the capital market side, but further down the road.
So I obviously think they're here to stay. I think as an asset class has shown its staying power. Bitcoin is now perceived, I think, rightly as digital gold. It has features which are unique, and the white paper behind Bitcoin is I think beautifully written. It's very clever. And there's other crypto native assets that are, I think, here to stay as well. I'm not kind of just going to put Bitcoin out there, but that's what I would say is the speculative end of the market, in the sense that these are assets that buy, sell, price movements. I'm more interested in the plumbing end of the market and how these technologies can change the plumbing of traditional finance. And I know there's other use cases. I know blockchains are not necessarily just a financial services kind of engine room, but for me, that's where my business is, and that's what I'm going to focus. And the bits that really interested me in that are, I'm going to go back to our business, the payments and the lending piece, because our payments rails are still driven by the old kind of post-war settlements of Swift, batch processing, things that made sense when you had cash or physical cash as the driver. But we're already seeing stablecoins generate real innovation for cross-border payments, for real-time settlement. And I think that's something that is fascinating to watch. And I think that tokenized deposit play is also going to be something that if you can start having some kind of yield-bearing instrument that can behave like cash, that's a huge game changer, because people would rather choose to have yield with their cash if they can, because it's in their best interest, if the system allows them to have that, of course. And the other piece that we've discussed is then tokenization and the engine room for the capital markets, other than payments. I think those are the two real build areas for the next 5-10 years. And the capital markets are really right as well for that same kind of plumbing innovation, because the long settlement transaction times, the complexity we have, where even some of the transactions for funds, for example, when you're moving funds, are still paper-based. I mean, this is we've done a lot of innovation in the front end with fintech, etc. But the back end, that's where this will sing, and I think that's going to be where we see the next.
Focus. Actually, some of the conversations or discussions on the attractiveness of a digital assets approach, even to payments, is the back office. In theory, at least, that it's more efficient. It makes any transactional process a lot more streamlined. It takes care of the legacy platforms that banks have been using. All of that. Are you willing to accept that some of that may well be not true? Because blockchain as a technology can be cumbersome in its own way, right? So, so it will work for certain types of transactions and not for others.
Completely. And again, as you can probably hear, I'm not doctrinaire about this. I think if it works, amazing, let's use it. And I think in some cases it really does work. I think the examples I gave for stablecoins and tokenization, like those really impact capital markets and payments respectively. However, it doesn't make sense to do in some other things. And we don't need necessarily a full blockchain backend to digitize high-speed transactions that maybe could be centralized. I think there's a really interesting book by Chris Dixon called Read, Write, Own, where he talks about, I thought it was really interesting, technology as destiny. So if the plumbing is open source, and if the plumbing is something that allows for innovation on top, and it's not command control like we see with the big tech firms in the US, where they kind of put the ramps down to make sure that there's no innovation from third parties. With the open architecture, you get much more growth and scale, but it's messier. It's the bazaar analogy versus the cathedral of beautiful apples that kind of everything works beautifully, but you pay for the privilege and you don't get as much choice. The cathedral approach works for some things. For example, central bank clearing and settlement with wholesale banks. I mean, you could do that on blockchain. You could easily do that also on a centralized books and records. And that doesn't necessarily have the same impact on, when I say the broader bazaar of the cut and thrust of retail and SME. At that level, it makes much more sense, I think, to have a more open architecture at the back end, because there's a lot more people that need to trade on that. And they'll be thinking of things that the centralized actors will never think of. But regulation has to, of course, accommodate for the messiness on that side for real innovation to happen.
You triggered something else, APIs. If the end user, if it's open source and it's open architecture, your very clients will be able to build their own APIs on that. I mean, is your thinking further down? I mean, down the road on that front?
Yeah, I mean, this is admittedly early days. I mean, we all know open banking has done a lot to open up the kimono and let people see through what kind of innovation they can build on the payment side. We're just seeing the early days of open finance, which is something similar. How do you crack open the data around lending and make sure that that's visible and transparent? This will be a top-down regime. This has to be mandated from regulators and central banks for it to be opened up. But I think this is where, I mean, I've been intrigued. For me, Web3 is the solution to open finance to properly deliver that for a broader use base. But we're not seeing much spoken about the interaction between open finance and Web3 yet. And I think that's going to be where a lot of business opportunities and innovation will sit in the coming years.
Okay. And also, I mean, there's a lot, that we've learned from open banking in the UK. What works and what doesn't work, what the customer is comfortable doing and what he's not. And he always de factos back to the traditional banks. So, moving away from that is, it's not a given.
No, and I think, I mean, this is where there are features which are really interesting. So with credit cards, people like using them because they get points, they get the surety if a transaction fails, they can get some recourse to get the money back if the business trade doesn't complete. And they're willing to pay, say, 1 to 2% of a transaction for that almost insurance premium to cover those things. I think that's probably a bit too much, really. I think we shouldn't have to pay that as a tax implicit. And there's one or two things that are holding back open banking. And the biggest one, definitely in the European Union, but also in the UK, we haven't gotten rid of it, is we're mandating that any form of transaction yields the same end price for the consumer. But if we allowed a client to choose to say pay cash or medium like open banking that doesn't include those extra fees, that 1-2% that perhaps the card carriers would take, and those costs were saved by the user, say when they're paying for their petrol at the petrol station, I think a lot of people would tip over. But until that legislation changes, we're not going to see that mass adoption, I think, because those small savings are not visible to people. But open finance, I think, will have similar dynamics. It's a bit like game theory. You see the existing incumbent actors wanting to keep the market a certain way, legislation, lobbying, all these kind of various things to, even if innovation's there, it doesn't necessarily take root until critical mass again kicks it through.
Yeah, so coming back to this thing where I was trying to draw a parallel between what you do and what the early days of peer-to-peer bank finance, is there always a temptation? And I'll leave this to the last question, but this is a continuing conversation. Is there a temptation to have a balance sheet eventually?
Yes. Yeah, I mean you've hit all the key points. So yes. And we have to, I think. And it goes back to trust. If I'm going to be originating digital debt for SMEs and I don't have any chips on the table, it's going to be tough for me to build the market and get actors interested. I think there's various ways we can do this that I still would have comfort in our business model to accommodate. One could be our own credit fund, where we raise with independent money and just start putting, we start leading the origination, put a couple of percentage points of the overall package in. And eventually, maybe we could look at having what I think could be a ring-fenced bank, where we have a subset of our clients, which are perhaps longer duration. If we have, for example, the more family office end of our client base with trust structures, these are not deposit bases that are going to be as much having a flight risk. And we can then offer them features like maybe a higher yield if we use those monies to start pricing digital debt. But I do not want to put everything I have on a bank balance sheet. I've learned by watching the market. I think our end of the market, it doesn't fit well with the kind of business we facilitate.
But Sean, I want to ask you this one final question. Like your background was insurance.
Well, very early days. So I cut my teeth at Zurich in their internal consulting team, and then I ended up in banking only 2 years thereafter. So I had 2 years in insurance.
Okay, so is there any DNA from that ecosystem that you're carrying into what you're doing today at all? I mean, that transition, I wouldn't expect an insurance man to do balance sheet lending.
No, I'm really a banker. I mean, I can't pretend. Yeah. But I mean, there are some. I mean, I think there are interesting proxies in the insurance markets. The insurance-linked securities market, I think, is very interesting.
Okay, yeah, that's true.
But that's an aside.
Yeah. That's an intellectual exercise. Yeah. No, this has been a fascinating conversation, Sean, and it's, as you say, it's early days, and I'm excited that you've been at this for 6 years now.
Nearly, yes. Yeah.
Yeah. So the proof of concept aspect of your business is already in place.
Yeah, I mean, we have revenues, we have clients that are thankfully happy. It's more for us as a scaling story now, and that's a bit of fundraising I need to do and a bit of hitting the pavement. But I think our tech works. It's more finding the right partners now in the next stage and building.
Well, all the very best. And I'd like to come back to you, as the digital asset space evolves and DeFi evolves as well. And in fact, the exciting thing is to see someone like yourself applying DeFi principles back into traditional banking, right?
Yeah.
And
we're not alone, thankfully. But I think we're happy to see that there's good actors trying to do this, and I think it's for us exactly what our clients need to get that growth capital. So we're also excited. And thank you.
Thank you very much, Todd. It was a great conversation.